In 2026, a retired couple is bringing in about $80,000 a year in retirement income, and when they file their taxes this spring, the IRS is going to count almost none of it. Not because they cheated or found some obscure loophole buried in a tax shelter, but because they know which types of retirement income the tax code simply does not touch. There are 7 of them, and while most retirees know 1 or maybe 2, the other 5 or 6 sit there completely legal and completely unused for an entire retirement. So by the end of this video, you will know all 7, including the last one, which almost nobody believes could possibly apply to them, though they are wrong. Hey, I am Smart Retirement, and I am here to give you the kind of financial information that actually helps you keep more of what you have earned in retirement, the stuff nobody sits you down and explains. So if that sounds useful, hit subscribe, because that is exactly what this channel is built around. Let us start with the one you have probably already heard of, because even that one has 2 layers almost nobody explains, which is Category 1, the Roth account, where qualified distributions from a Roth IRA are not deferred income or income where you settle up later, but simply not taxable income since the IRS has no legal claim on a qualified Roth distribution. The part almost nobody explains is the 5-year rule, meaning a Roth IRA distribution is only tax-free if the account has been open for at least 5 years, and you are at least 59.5 years old. And if you converted a traditional IRA to a Roth a few years back, that conversion starts its own 5-year clock separate from your original Roth, which quietly disqualifies tax-free treatment for people who converted late and withdrew too soon, bringing a tax bill along with the distribution. Breaking this down by where you are starting from, if you are a lower income retiree drawing mostly from Social Security and a small IRA, a Roth conversion done carefully over several lower income years can permanently move future growth out of the IRS reach. Whereas if you are a retiree with a larger account balance, the 5-year rule becomes your planning constraint rather than your obstacle, because you have time to stage conversions deliberately. One more piece matters just as much, as there are no required minimum distributions from a Roth IRA during the owner lifetime, unlike at age 73 when the IRS forces taxable withdrawals from traditional IRAs and 401k plans whether you need the money or not, meaning with a Roth you control the timing entirely. While on the subject of forced withdrawals, there is a related move worth knowing if you are 70 and a half or older and charitably inclined, known as a qualified charitable distribution, where you direct money straight from a traditional IRA to a qualified charity so that transfer counts toward your required minimum distribution without ever showing up as taxable income or touching your adjusted gross income, Social Security calculation, or Medicare premium. Furthermore, if your income is too high to contribute to a Roth directly, there is a legal workaround called a backdoor Roth conversion, where you contribute to a traditional non-deductible IRA first and convert it to a Roth shortly after, triggering little to no additional tax since the contribution was already after tax, allowing higher earners a door into no RMDs and protected premiums. Additionally, once you turn 65, the standard deduction itself gets a boost through an extra standard deduction applied automatically when you file, which stacks with everything else here to quietly shrink the amount of income that is taxable in the first place, regardless of which bucket it came from. That leads into Category 2 because it works the same way at the income level for a different asset class, as municipal bond interest is excluded from federal gross income under the tax code and often free from state income tax if you buy bonds issued by your own state. Taking the couple from the opening, if a portion of their $80,000 is routed through qualifying municipal bonds instead of a taxable bond fund, that interest never enters their taxable income calculation, Social Security threshold, or Medicare premium calculation, making it real money arriving in their account that simply isn't there for tax purposes. For a lower income retiree, municipal bonds may carry a lower nominal yield than taxable alternatives, but the after-tax comparison often still favors the muni depending on your bracket, while for someone in a higher bracket, the tax equivalent yield on munis frequently exceeds what taxable bonds pay out after the IRS takes its cut. One honest caveat worth knowing is that while municipal bond interest is exempt from income tax, It still gets added back in when the IRS calculates whether your Social Security benefit gets taxed, meaning munis are excellent when your income sits comfortably above or below thresholds, but loading up on them right on the line can push you over it, so running the numbers first is crucial. Beyond federal code, your state matters too, as a number of states don't tax retirement income the way the federal government does by exempting Social Security, excluding pensions or IRAs, or having no state income tax at all, which is worth checking since state treatment is rarely identical to wages from a job. The next category surprises people because it does not feel like income at all. But Category 3 is gifts and inheritances under Internal Revenue Code Section 102, where gifts and inheritances are excluded from the gross income of the recipient, meaning if adult children give you money or you inherit cash from a relative, that money is not your taxable income. The annual gift exclusion threshold for 2026 is $19,000 per person per giver, so a married couple with 2 adult children can receive up to $76,000 in a single calendar year in gifts with zero federal income tax owed by anyone receiving it, completely outside the tax system. For inherited assets, the cost basis steps up to the fair market value on the date of death, meaning if you inherit stock that grew from $10 to $90 over 30 years, your basis becomes $90, and 30 years of taxable gain is erased, though an inherited traditional IRA or 401k does not get this step-up treatment and must generally be emptied within 10 years by heirs paying ordinary income tax on every dollar. To illustrate this, consider Patricia, a 67-year-old retired registered nurse in Savannah, Georgia, who inherited $41,000 in cash from her mother's estate and received a $19,000 gift from her 2 adult children in the same year, receiving $60,000 total while owing zero federal income tax on any of it, because under Section 102 it was excluded from her gross income entirely. On the other end of the spectrum, consider a retired couple with a larger estate wanting to move wealth to 3 grandchildren, where splitting the $19,000 annual exclusion between 2 givers and 3 recipients allows them to move $114,000 out of their estate in a single year with no gift tax return required and no income tax owed by anyone on either side, moving significant sums across generations without triggering income tax. However, remember that while gifts are invisible to the IRS, Medicaid looks back 5 years at money given away, meaning tax answers and Medicaid answers are 2 separate questions. Right now, if you want all the exemptions, breaks, and refunds most seniors qualify for, but never claim laid out state by state and form by form, check out the Senior Exemption Playbook linked in the first pinned comment below this video to see what money you are leaving on the table. Moving forward, Category 4 covers life insurance proceeds and policy loans, where beyond income tax-free death benefits paid to beneficiaries, permanent life insurance with accumulated cash value allows you to borrow against that cash value tax-free because you are borrowing against an asset rather than withdrawing money, leaving the IRS with no claim on loan proceeds as long as the policy stays in force. This serves as a sequencing tool in years when ordinary IRA withdrawals would trigger higher Social Security taxation or Medicare surcharges, allowing you to access cash without adding a single dollar to your modified adjusted gross income to protect your Medicare IRMAA surcharges, which are recalculated based on income from 2 years prior. A responsible caveat is that policy loans accrue interest, and if the loan balance exceeds the cash value, the policy can lapse and create a sudden taxable event on amounts above what you paid in, requiring careful monitoring alongside a financial professional. Next is Category 5, the Social Security partial exclusion window, where up to 85% of your Social Security benefit can be included in taxable income, meaning at minimum 15% is always tax-free at every income level, and much more for lower-income retirees. Provisional income is calculated as adjusted gross income plus tax-exempt interest plus half of your annual Social Security benefit, where single filers pay 0% tax below $25,000, up to 50% between $25,000 and $34,000, and up to 85% above $34,000, while married joint filers face thresholds of $32,000 and $44,000. Because these thresholds have not been adjusted for inflation since the 1980s, normal inflation has quietly pushed tens of millions of retirees into higher tax brackets without legislative votes. Going back to our opening couple, drawing $80,000 carelessly via large traditional IRA withdrawals pushes provisional income well above $44,000 to tax 85% of their benefits, whereas drawing from Roth accounts, municipal bonds, gifts, and policy loans keeps provisional income below the threshold so that 0% of their Social Security becomes taxable, saving thousands through strategic sequencing. Category 6 is health savings account distributions for qualified medical expenses, which is the only account featuring a triple tax advantage where contributions are deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. Rather than spending HSA funds immediately, the IRS imposes no time limit on reimbursements, allowing you to pay medical bills out of pocket today, let the HSA grow untaxed for a decade, and reimburse yourself completely tax-free later, while also using HSA funds to pay Medicare Part B, Part D, and Medicare Advantage premiums tax-free. Consider Diane, a 71-year-old retired pharmacist in Scottsdale, Arizona, who contributed to an HSA for 9 years, paid $23,000 in medical costs out of pocket while saving every receipt, and later reimbursed herself for the full $23,000 over 3 years tax-free while the balance grew, providing a strategy to pull tax-free cash flow without disturbing Social Security thresholds. Finally, Category 7 is return of basis or cost basis recovery, which relies on the mathematical fact that when you invest after-tax money into a financial asset, that original contribution is your cost basis that was already taxed, meaning its return is legally not taxable income upon withdrawal or sale. This applies to non-qualified annuities funded after tax, where distributions become tax-free once gains are cleared, after-tax brokerage accounts where only growth above basis is taxed, and real estate where basis includes original purchase price plus documented capital improvements. Consider Gerald, a retired contractor in Memphis, Tennessee, who sold a rental property for $310,000 after purchasing it for $95,000 and documenting $47,000 in capital improvements, resulting in an actual cost basis of $142,000 and a taxable gain of $168,000 instead of $215,000, saving thousands simply because he kept every contractor invoice and permit in an accordion folder for 22 years. To put this into action, classify every account you hold, locate cost basis documentation, calculate your provisional income against the $25,000 and $32,000 thresholds. Review your Medicare RMA notices, utilize qualified charitable distributions if applicable, maintain dedicated folders for HSA receipts and property improvements, verify state tax rules, and sequence your distributions by pulling. Roth and municipal income first and traditional IRA funds last to keep your total tax bill as close to zero as legally possible.